Hey everyone, welcome back to the channel. This is episode number 2 of the Magic Formula portfolio series, where I'm trying to build up a portfolio using the Magic Formula strategy as made famous by Joel Greenblatt, a value investor who's had a pretty great track record thus far. But he wrote a book a while back called The Little Book That Still Beats the Market, and then there's a precursor to that, The Little Book That Beats the Market, the still being the sequel. So he talked about this very simple strategy where you organize stocks using this formula that tries to give you the best deals on high quality businesses. That's the goal, and at least with the track record shown in the book, it was a really great strategy in the initial period that was studied. However, there's some controversy in how well it's actually worked in the last 15 years or so. So I wanted to put it to the test. That's the purpose of this series. Every single month, I'm adding $500 into this portfolio, and I'm adjusting this list using the Magic Formula Investing website, which automatically shows you the top stocks based on the Magic Formula screener portfolio. And then any stock that falls off the list at the end of the month is taken off, and any stock that's still on it will get money added to it theoretically. Since I'm adding $500, and this platform M1 Finance automatically rebalances any new money to go towards underweight sections of the portfolio, meaning that, say this holding right here, Tupperware, if it falls below 3%, that would mean it is underweight. So any other underweight sections, including Tupperware, would get money prioritized towards that. Any new dividends, any new contributions I make each month will go towards that automatically. And anything that's overweight, over the target allocation that you set in M1 Finance, it won't get anything added. So it appears that you wouldn't be buying into more expensive businesses and you'd continually buy into the cheapest ones, though it's debatable. We'll see what actually happens. I'm trying to be very passive with this approach. That's the whole appeal of the Magic Formula portfolio strategy. It's supposed to be sort of a semi-passive, semi-active, not really, strategy that you can be kind of mindless about if all goes well, of course. And that's why I wanted to put it to the test. I don't want my IRA, which is what this is in, my retirement account, to be super active or super stressful. So I wanted to try this with that. Also gives me an excuse to actually make contributions here into my IRA, since I actually did not max out my IRA last year, partly because I was only working part-time, but also I wanted to put that cash towards other investments, mainly the real estate deal I completed back in the summer of 2020. I've also updated the tracker sheet, which I always include in the description below, and I am now doing a monthly sort of tracker where I show anything that was added and the amount that was actually added into each holding. It's organized alphabetically, just like the Magic Formula Investing site. And then also you can see this month, which is a little bit more telling, April 2021, it shows holdings that were added and then any that were removed, as well as the amount added versus the amount removed. So you can easily take a look back at the history of this portfolio. If you want to do any back testing yourself, go ahead. So this can be a great way to track that and see maybe what's working, any trends that we might notice with the Magic Formula strategy. Just trying to collect some data here, since some of the data, at least, is not very easy to get through with this strategy from people who have tested it. So I want to make sure I have this resource there for you guys, and as well as myself. And as I pointed out last time, the Magic Formula list is very skewed towards pharmaceutical companies. And I think that is because of the fact that it uses return on invested capital from the previous year. So if a pharmaceutical company has a great year, they invested a bunch of money into a new drug, for example, and that drug takes off, then all of a sudden their return on invested capital looks amazing to where it might be more likely to get on this list. That's just a hunch. But I actually wanted to take some time to go over the return on invested capital metric, since it's one of the two things that makes up the Magic Formula. So here's the actual book. This is where Joel Greenblatt actually goes over what return on capital is, return on invested capital. So here's a very easy to follow example. Let's say, for instance, what if we found out this is about someone opening up a gumball store? That's kind of this example he's using, very simple example. But Jason has $400,000 invested to build each of his gum stores. This includes everything in the business. So he invests $400,000. And that each of those stores earned him $200,000 last year. So $400,000 invested, $200,000 earned per store per the $400,000 invested. That would mean, at least based on last year's results, that a typical store earns $200,000 each year from an initial investment of only $400,000. That works out to a 50% yearly return, which is $200,000 divided by $400,000, on the initial cost of opening a gum store. This result is often referred to as a 50% return on capital. Without knowing much else, earning $200,000 each year from a store that costs $400,000 to build sounds like a pretty good business. So, and then he does another example where a business isn't earning a lot of money. I don't know why he says, here comes the hard part. He says not really, it's definitely not hard. It's the same sort of example, just with a business that doesn't earn as much. So that's what return on invested capital is. The business invests money into itself, and then the amount of money it earns back is the return on that invested capital. It's a pretty simple metric. Obviously, a very important one for determining the health of the business. You want to see a business that is putting money into itself and then is returning more money back. And if it's not earning a lot back, it's probably not a great business, or it's going through some hard times, or somehow is going through something that might add risk to what's going on. And the return on invested capital metric is something that's really important, especially for those of you who are dividend investors out there who are really gunning for dividends. You look at dividend yield as a primary metric for whether something is a good investment, but you really got to take a look at what the business could have been doing with that money. For example, if we have that same business with a 50% return on invested capital, you'd be hard pressed to find an investment yourself that is returning you that amount of money. Maybe you can. Of course, there are plenty of great investments out there, and if you happen to find one, you want to put a lot of money into it, most likely. But let's say you have this business that's making 50% on the money that it keeps, but instead you really need that dividend, and that dividend yield is important, but the dividend that the company pays out then can't be reinvested into the business. It's being given to shareholders. So unless you could have made the 50% that the business would have produced with that money, all of a sudden it looks like you're losing now, because the business could have made 50%, but you're only making 10, 12, 15 if you have a great stock investment somewhere else. It's very hard to get those high returns on your own just by picking stocks. It's very hard to do that. It takes a lot of diligence. If the business is already doing that for you, why wouldn't you let it keep doing that? That's just something that a lot of dividend investors, at least newer ones, don't really pay attention to. But really, any stock investing, you want to take a look at the return on invested capital. What is the business doing with the money that it puts into itself? And if it has a very low return on invested capital, then maybe you do want a lot of dividends. Get the money given to you, get it out of that bad business. But at that point, you might just want to sell off if the business really is poor. But if it's just a temporary thing, then you might stay through it, but whatever. The point is, return on invested capital is a very important metric for determining whether something is a good business. Now, what amount or what years should you look at for return on invested capital? And that's where the magic formula strategy comes into a bit of a problem, in that it is very short-term looking on return on invested capital. And you probably want to look at the whole picture. If a business has been around for 10 years and its return on invested capital has consistently been 20% per year, you could safely assume that it's probably going to continue a trend sort of like that unless there's some huge shift in its fundamentals. Whereas if you have a newer business, maybe the return on invested capital looks incredibly high since it just turned something around, it just made a discovery, and it can't sustain that same return on invested capital in the near future because it just was getting off the ground, so the return looks incredibly high. Going from $1 in earnings up to 100 is a huge, massive return on invested capital, but that doesn't mean that it's going to be able to keep up that sort of pace exponentially forever. So you got to keep that in mind, and it's helpful to look at something like that, especially with a pharmaceutical company. I would think you could see that maybe it had a very negative return on invested capital for a while, and then it had this fluke year where a drug went live that happened to get a lot of steam, and the copycats aren't out yet, so it has that sort of market monopoly on this drug or whatever it is, and then the return on invested capital looks super high. That's just my hunch there with what's going on with these pharma companies being so heavily prevalent in the list, but that goes for any business really. There are short-term events that might boost return on invested capital, and it won't be able to sustain that for the long term. The company doesn't have a moat necessarily when it has a high return on invested capital just in the last year or in the short term. You want to look for those companies that have a long road ahead of them of great return on invested capital. Obviously, you can't tell what the future will actually hold, but that's what you're trying to do. And looking at the past can hopefully be indicative of the future. Nothing truly is, but typically past data can help towards making future decisions, and that's often what we're trying to do with any sort of investing. Now I want to get back to this list to show you guys what holdings were actually removed from the list this time. We had Biogen that was removed. That was down a little bit since my initial investment of $10. Dish was removed. That was up a little bit. IDT was removed, and that was also up a little bit. Legacy Housing was added, but that's not available on M1, so I wasn't able to add it. McKesson, Meredith, and Michaels were removed. Michaels, I believe, went through a merger with another company, so I don't even know where that stock went. It's in the middle of a merger, but I think I should be getting $10 back somewhere down the line. But anyways, that's what happened there. I was a little bit up on Meredith, a little bit down on McKesson. And then we have Trinet Group that was also removed, and that was also down a little bit. And all these green ones were the ones that were added: Sleep Number, Surface Oncology, Urban One, Waiter Holdings, which is not available on M1, so I couldn't add it. And then Legacy, I pointed out. And then Co-Diagnostic Inc. was added as well. And then Biodelivery Services International also added, another pharma stock. So that's the big changes in the portfolio. Otherwise, I added to any positions that were already there to try and balance out the portfolio as much as possible and keep it balanced through this whole process, and we'll just see what happens from there. And that has been reflected in this M1 portfolio. If you want to copy it, if you want to get on the Magic Formula investing portfolio bandwagon, I'll always include a link in the description below to this particular episode's portfolio, and you can actually copy it in M1 Finance if you happen to be in the US. It's a great free brokerage to open up an account for free, no minimums or anything like that, and you can actually directly copy this portfolio. It takes a snapshot that you can transfer over into your own, and you can edit it if you want to. If you don't want to actually copy the Magic Formula exactly, you can remove certain holdings if you want less pharma stocks, for example, or maybe you want more pharma stocks. You can definitely do that. So it's a great little tool with M1 Finance. I also mentioned that auto invest feature. I am an affiliate of M1 Finance. I like the platform a lot, very easy to use, and plus the interface is just fantastic, which I always love. So definitely would recommend taking a look at it. And if you want to copy the portfolio, you can do that. Again, the links are down in the description. I got my affiliate link to open up an account there, which would definitely help me out a lot. And I guess I should address the elephant in the room, if it can be called that, and that's that the portfolio in its first month didn't really do anything. It was quite flat. So we'll see what happens in future months. Obviously, it's not going to always beat or always underperform the S&P 500 or any broader index. There's going to be volatility in any investing strategy. Some months, I'm sure this portfolio will beat the S&P. Some months, it will lag behind it. Even some years, it might lag behind, or for some years, it might overperform. So we'll see what actually happens. The point is, I'm trying to build this track record now and see if the adjustments I'm making to it with the auto reinvest, auto rebalancing sort of way, and the monthly removing of stocks that fall off the list, I want to see what that does to this over the next couple of years and see what happens. And if it's worth continuing the strategy, if it seems like it's continually investing in high quality businesses, then sure, I'll keep going with it, since this is an interesting sort of experiment in a semi-passive kind of value investing. And just because I mentioned it earlier, here is the Magic Formula Investing Screener. It's magicformulainvesting.com. You can create an account for free, and then you can screen stocks based on the Magic Formula, which will give you ideally the cheapest, best businesses at that given moment based on your actual criteria they put in. You can set the minimum market cap and the number of stocks in the list as well. I'm doing the 50 at 50 million. That's how I'm doing it. The $50 million minimum market cap, since you don't want too small, since it might not be enough of a track record or might not really be a great business. It could just be a fluke. Granted, at the $50 million range, you could still have plenty of that, but I wanted a pretty broad range to see what this list would do, and this is generally what it recommends. You're going to reduce your volatility most likely if you increase that minimum market cap, but you might limit your returns based on at least what the book was showing, that the higher market cap stuff generally didn't return as much since it should be lower risk, but you never really know with the stock market and investing in individual companies. Lots of things can go wrong with big companies, just as lots of things can go wrong with little companies. But whatever you enter up here, it will spit out a list of ideally the cheapest, best companies, but that's assuming the Magic Formula is actually working as it should. So you never really know if it's going to actually be accurate, since we're trying to predict the future, and nothing's really going to be able to predict the future with any true certainty. But that's what the Magic Formula is trying to do. It's trying to insulate you by investing only in the best businesses at the best prices that you could get relative to the broader market. Again, that's magicformulainvesting.com if you want to take a look for yourself. But that's pretty much all I wanted to go over today. Just wanted to explain return on invested capital a little bit more, what that actually means and why it's important for stock valuation and weighing the quality of a business. It's definitely an important metric that you should be paying attention to in whatever stock investing you're doing. And maybe you discount it for some businesses, and maybe you put a sort of premium on it for other businesses that have proven that they have a sort of moat. The Magic Formula is not really currently doing that, so that's a cause for concern, but it's a start at the least, so we'll see how it does in the long term. Whatever the case, next month on the 28th of every single month, I'll be doing an update on the Magic Formula portfolio. I'll add another $500 to it every single month to see what happens and see what we can learn from this strategy, going over different aspects of why the strategy should work, or maybe how it's done in the past, maybe ways that you could think about adjusting the strategy if it's something that you want to adopt. Obviously, none of this is financial advice. It's just showing you this in real time, showing you what I'm doing, because I think transparency is key, but also hopefully this can be interesting and informative for learning how to invest and maybe learning about a particular strategy that might be interesting. And like I mentioned earlier, definitely check out M1 Finance. I got all those links in the description below. It's free to check out, so definitely do that. I got some tutorials on how the actual platform works as well, so do take a look at those if you're at all interested. And whatever the case, if you like this video, definitely like it, since that would help the channel out a lot. And be sure to subscribe so you don't miss any new videos, whether that be more updates to the Magic Formula Portfolio series or to any of my other series, including my net worth series that I do on the first of every month, where I actually do a full breakdown of all my holdings, debt, all that great stuff to give you guys maximum transparency, because that is something I really value on this channel. But until next time, take care.